Caroline Ellison is set to walk free in January 2026. Anthony Scaramucci's blue-chip crypto basket is underwater, and gold-backed stablecoins plus a new Exodus digital dollar are quietly reshaping where serious money parks in crypto. While retail traders chase meme coins, the real power moves in crypto are happening behind the scenes. From Caroline Ellison's early release after the FTX collapse, to Anthony Scaramucci's favorite crypto basket sitting at a loss, to gold-backed stablecoins and a new fully reserved digital dollar that could change how you use money every day. In this episode of BlockNexus TV, we break down what's really happening under the surface and what it could mean for the next phase of the crypto market. Stay to the end, because the last segment on stablecoins could be the biggest shift nobody's talking about. Segment 1. Caroline Ellison, out early but not free. First, the FTX saga is entering a new chapter. Caroline Ellison, the former CEO of Alameda Research and one of the central figures in the FTX collapse, is now scheduled for release from federal custody on January 21, 2026. Federal Bureau of Prisons records show that date is about 4 weeks earlier than prior estimates, meaning she will leave physical custody after serving less than half of her original 2-year sentence. Ellison was sentenced in September 2024, but her path changed dramatically when she began cooperating with prosecutors. She became the primary cooperating witness in the case against Sam Bankman-Fried, whose testimony helped secure his conviction and 25-year federal sentence. In October 2025, Ellison was moved from prison into community confinement, a halfway house or home confinement under federal supervision in New York. Then, on December 19, 2025, she agreed to a 10-year ban from serving as an officer or director of any public company or cryptocurrency exchange, effectively locking her out of regulated finance for a decade. So yes, she may walk out of custody in January, but she will still be under supervision and barred from running anything like FTX again. For the crypto industry, Ellison's case is now a textbook example of what cooperation deals and post-FTX enforcement actually look like in practice. Segment 2. Scaramucci's favorite crypto basket is in the red. Next up, let's talk about Anthony Scaramucci, the hedge fund manager who has gone all in on crypto. He has publicly said that more than half of his net worth sits in Bitcoin, with an even larger personal position in Solana, all staked, plus smaller allocations to Avalanche and Ethereum. Now here's the twist. According to a recent analysis, a hypothetical $1,000 portfolio split evenly between Bitcoin, Solana, Ethereum, and Avalanche at the start of 2025 would be sitting at a loss today. Despite Scaramucci's bullish stance, broad market drawdowns in 2025 have pulled that basket below break-even, with some of those coins down more sharply than others. Scaramucci has framed this not as a failed trade, but as a multi-year thesis. He repeatedly casts Bitcoin as digital gold and sees Solana and Avalanche as long-term infrastructure plays in a future where only a handful of major blockchains survive. He has even argued that Solana is positioned to be one of the dominant chains in tokenization and high-throughput applications, while keeping only a relatively small position in Ethereum. The key takeaway: even the people who are all in on crypto blue chips are riding out serious volatility in 2025. But they are thinking in cycles and decades, not weeks. Segment 3. Gold-backed stablecoins quietly explode. While traders obsess over price action, another corner of the market is exploding: gold-backed stablecoins. New data shows gold-backed stablecoins have surged to around $4 billion in market capitalization in 2025, nearly tripling from early in the year. One token now accounts for roughly half of that entire market, and together the top two tokens control nearly 90% of all tokenized gold in circulation. The leading token overtook its main rival after expanding supply aggressively throughout 2025, riding both rising gold prices and increased demand for on-chain safe haven assets. These tokens represent fractional claims on physical gold bars stored in secure vaults, giving holders direct exposure to the gold price through blockchain-based assets they can trade or move instantly. A major stablecoin issuer has quietly become one of the world's largest non-sovereign gold holders, with reserves comparable to some smaller central banks, according to data referenced in the report. What this signals is a shift in how people think about stability in crypto. Instead of parking value only in dollar stablecoins, more capital is experimenting with tokenized commodities, assets that combine old-school hard money like gold with the liquidity and portability of modern crypto rails. Segment 4, Exodus, MoonPay, and the fully reserved digital dollar. The final piece of this puzzle is what's coming in 2026, a new fully reserved digital dollar that aims to make stablecoins feel like everyday money, not just trading tools. Self-custody wallet provider Exodus is partnering with MoonPay and infrastructure platform M0 to launch a US dollar-backed stablecoin in early 2026. MoonPay will issue and manage the asset using M0's open stablecoin infrastructure, and the token is designed to be fully reserved and pegged one-to-one to dollars. Instead of focusing on speculative trading, this digital dollar is being built to power Exodus's ecosystem and a feature called Exodus Pay, a wallet card payment stack for everyday spending and rewards. The goal is simple: let users spend, send, and manage digital dollars inside a self-custody wallet without needing to understand crypto at all. Exodus has even backed this strategy with a reported $175 million acquisition of W3C Corp and its subsidiaries Bon and Monovate, giving it an integrated stack for wallets and payment cards. This move comes as regulators worldwide, including in the US, are accelerating frameworks for fiat-backed stablecoins, and as big players like Visa and others experiment with stablecoin payments. If Exodus and MoonPay execute, this fully reserved digital dollar could compete directly with the biggest names in the stablecoin race, but with a stronger emphasis on transparency and self-custody. Segment 5. What it all means for crypto. When these stories are viewed together, a bigger narrative emerges. On one side, there is the fallout of the last bull market, FTX, criminal cases, and cooperation deals like Caroline Ellison's that define the new enforcement era in crypto. On another, there are high-conviction players like Anthony Scaramucci who are willing to sit through temporary losses on Bitcoin, Solana, Ethereum, and Avalanche because they see them as long-term infrastructure, not just trades. And stacked on top of that, there's a quiet but powerful shift into asset-backed and fully reserved digital money, from gold-backed stablecoins nearing $4 billion to new digital dollars designed for real-world payments. Whether this sets up the next bull cycle or ushers in a more mature, regulated, and utility-driven phase for crypto will depend on how regulators, builders, and users behave over the next few years. What is clear is that the future of this space will be shaped as much by what happens off-chain, in courtrooms, boardrooms, and policy debates, as by the price of any single token on a chart. This content is for educational purposes only and not financial advice.